Imagine waking daily inside an economy moving forward, yet somehow never actually escaping yesterday's financial mistakes forever. Markets celebrate victories, governments announce recoveries, yet something beneath everything remains strangely frozen beneath constant optimism today. Companies survive without growing, debts expand without disappearing, and prosperity somehow feels permanently postponed for almost everyone. Welcome to global finance's strangest mystery, where endless rescues slowly transform progress into permanent economic repetition and stagnation. This isn't a conspiracy or accident. It's the predictable outcome of incentives quietly reshaping financial systems everywhere today. Understanding this loop explains why recoveries increasingly resemble reruns instead of exciting chapters filled with genuine economic transformation ahead. Decades ago, recessions acted like harsh winters, eliminating weak businesses while allowing stronger companies to eventually flourish again. Painful? Absolutely. Efficient? Usually. Resources shifted naturally toward better ideas, healthier balance sheets, and productive innovation across economies. Failure wasn't celebrated, but it performed an uncomfortable function every healthy capitalist economy quietly depended upon for resilience. Businesses unable to adapt eventually disappeared, freeing workers, capital, equipment, and opportunities for stronger competitors eager to expand. Creative destruction sounded brutal, yet it continuously refreshed economies by replacing yesterday's inefficiencies with tomorrow's productivity and growth. Then, something gradually changed after repeated financial crises forced policymakers into increasingly difficult choices protecting fragile economic stability across nations. Every rescue solved immediate panic, while quietly planting conditions for another rescue somewhere further down the road awaiting arrival. Temporary emergency measures slowly evolved into permanent features shaping financial decisions across governments, banks, corporations, and investors worldwide. That's where economists increasingly discuss something called financial zombification, an unsettling description hiding behind surprisingly ordinary headlines every week. A zombie company isn't collapsing dramatically, it's surviving without truly living, growing, innovating, or meaningfully competing anymore either. It earns just enough money to service debts, yet never enough to confidently invest or significantly improve operations. Instead of dying naturally, it simply exists year after year, absorbing capital while producing surprisingly little lasting economic value. Imagine watering a tree that stopped growing decades ago because removing it feels politically impossible or financially dangerous today. That image captures the uncomfortable logic keeping many struggling businesses alive despite weak productivity and shrinking long-term competitiveness globally. Why doesn't the system simply let them fail anymore, despite capitalism supposedly rewarding efficiency above everything else today? Because failure today rarely stays isolated. Interconnected finance spreads consequences faster than confidence can recover after panic begins anywhere. Banks hold corporate loans, pension funds own bonds, governments fear unemployment, and investors fear cascading market collapses simultaneously. Suddenly, rescuing one weak company appears cheaper than risking widespread financial instability affecting millions of ordinary households across economies. Short-term stability repeatedly defeats long-term renewal because immediate crises always demand urgent political attention before structural reforms ever arrive. Interest rates became one powerful tool repeatedly deployed whenever economies stumbled into recession or financial turmoil unexpectedly again. Lower borrowing costs encouraged spending, investment, refinancing, and confidence during moments when fear threatened freezing economic activity completely. Initially, these policies worked remarkably well, preventing deeper collapses while supporting employment and restoring confidence across nervous financial markets.
But every successful rescue encouraged greater dependence upon future rescues whenever similar pressures inevitably returned during later downturns worldwide. Cheap money slowly transformed from emergency medicine into permanent life support, sustaining increasingly fragile economic structures across developed markets. Borrowing became easier than restructuring, refinancing easier than repayment, and postponement easier than confronting uncomfortable financial realities directly. Businesses carrying overwhelming debts suddenly discovered survival required rolling obligations forward instead of fundamentally improving productivity or profitability anymore. Investors searching desperately for returns accepted greater risks because safer assets yielded disappointingly little income after repeated interventions worldwide. Debt accumulated quietly while optimism remained remarkably loud, creating impressive market performances masking increasingly fragile financial foundations beneath them. Governments also benefited from historically low borrowing costs, financing enormous deficits without immediately facing unbearable interest expenses or pressure. Political incentives naturally favored spending today while postponing difficult budget decisions beyond the next election cycle whenever possible instead. Households joined the pattern too, refinancing mortgages, increasing borrowing, and assuming cheap credit would remain available indefinitely going forward. Everyone adapted intelligently to incentives, yet collectively those incentives gradually reshaped the entire financial landscape into something unexpectedly dependent. Dependency rarely announces itself dramatically. It quietly becomes normal until alternatives feel almost unimaginable, despite mounting hidden consequences everywhere. Central banks increasingly found themselves expected to rescue markets whenever volatility threatened confidence or asset prices suddenly weakened significantly. Investors even coined nicknames implying monetary authorities would always cushion serious losses before widespread damage permanently spread across markets. Expectations changed behavior because believing rescue always arrives encourages greater risk-taking before genuine danger becomes visible to everyone involved. Economists call this moral hazard, though ordinary language simply describes it as confidence backed by someone else's safety net. Safety nets save lives during emergencies, yet permanent dependence changes incentives in ways rarely obvious until much later, unfortunately. Companies avoiding bankruptcy remain employers, taxpayers, borrowers, and stock market participants, despite contributing surprisingly little economic dynamism over time. Their existence crowds out younger competitors needing investment, workers, and opportunities to introduce genuinely transformative products into markets everywhere. Capital becomes trapped supporting yesterday instead of financing tomorrow, reducing overall productivity without triggering obvious immediate collapse or panic. That's why growth increasingly feels slower despite astonishing technological breakthroughs appearing almost every single year across countless industries globally. Innovation exists, yet financial resources frequently flow toward preserving established structures rather than accelerating disruptive newcomers with enormous potential. Productivity growth weakens, while debt growth strengthens, creating an economy appearing active without generating proportional improvements in living standards.
Stock indexes might reach records while everyday workers still wonder why prosperity feels strangely distant despite positive economic headlines everywhere. Financial markets measure prices, not necessarily economic health, creating powerful illusions during prolonged periods of abundant liquidity and optimism. Rising asset values often enrich existing owners faster than wages increase for people depending primarily upon earned income alone. Wealth inequality therefore widens gradually, not solely through greed, but through structural financial mechanics operating quietly beneath headlines daily. Asset inflation feels wonderful until purchasing ordinary necessities starts requiring increasingly extraordinary financial commitments from average households everywhere. Homes become investment vehicles first, affordable shelter second, reshaping expectations across entire generations entering adulthood with mounting uncertainty today. Businesses respond logically by prioritizing financial engineering over risky innovation, promising uncertain returns despite impressive technological possibilities ahead constantly. Share buybacks, refinancing, acquisitions, and restructuring often appears safer than expensive research requiring years before meaningful profits emerge successfully. Financial success increasingly depends upon balance sheet management instead of creating dramatically better products, improving everyday life for consumers everywhere. That's another symptom of zombification. Preserving financial appearance gradually outweighs expanding genuine productive capacity across competitive global industries today. Banks also face impossible balancing acts between supporting growth and preventing dangerous bubbles from inflating beyond sustainable levels indefinitely. Raise rates aggressively, fragile borrowers struggle immediately. Lower them excessively, debt expands faster than productive investment once again resumes. Every decision solves one problem while quietly creating another somewhere deeper within interconnected financial networks spanning continents and institutions alike. The result resembles endlessly squeezing one balloon, only watching another section immediately expand somewhere completely unexpected right beside it. Economic stability increasingly depends on continuous intervention rather than naturally self-correcting market mechanisms operating independently through competition and failure. That dependence doesn't guarantee collapse tomorrow, but it fundamentally changes how recoveries unfold after every significant economic disruption thereafter. Instead of clearing accumulated weaknesses, recoveries frequently preserve them beneath fresh layers of borrowing and optimistic financial narratives once more. Surface conditions improve while underlying vulnerabilities quietly compound, waiting patiently beneath celebrations surrounding every apparent economic rebound and recovery. This explains why each crisis increasingly requires larger interventions than the previous one, despite promises temporary measures remain exceptional always. Financial history begins resembling escalating sequels where budgets expand while original problems somehow never completely disappear from the storyline either. Even successful interventions carry hidden costs because resources devoted toward preservation cannot simultaneously finance transformation or future productivity gains effectively. Opportunity cost rarely appears inside headlines, yet it silently shapes prosperity through countless invisible decisions made across financial systems daily. Imagine repairing the same leaking roof forever instead of finally rebuilding the house using stronger materials and better engineering entirely. Eventually, maintenance consumes resources exceeding reconstruction, yet replacing everything feels frightening because temporary disruption appears politically unacceptable to leaders today. Global finance increasingly resembles that endlessly repaired house, balancing carefully upon aging foundations reinforced through repeated emergency interventions instead. None of this means policymakers are irrational or malicious. Their incentives often reward preventing immediate disasters above distant improvements naturally. Voters remember today's unemployment more vividly than hypothetical productivity gains potentially arriving 10 years into the uncertain future ahead. Markets also reward quarterly stability more consistently than long-term restructuring carrying unpredictable financial consequences for executives and investors alike. Every participant behaves reasonably within existing incentives, yet collective outcomes gradually drift toward persistent economic stagnation despite remarkable technological progress today. That's the paradox making zombification so difficult recognizing before its cumulative effects become deeply embedded across financial institutions everywhere globally. No dramatic collapse announces its arrival because everything continues functioning just well enough to postpone uncomfortable structural reforms repeatedly instead. Airplanes still fly, supermarkets stay stocked, markets open daily, and employment mostly continues despite weakening long-term economic momentum beneath. Normality becomes surprisingly convincing even while underlying systems quietly accumulate pressures requiring increasingly extraordinary interventions to remain stable indefinitely. History suggests prolonged imbalances eventually resolve, though predicting timing remains notoriously difficult even for experienced economists and investors alike.
Japan's experience demonstrated decades of slow growth despite advanced technology, sophisticated institutions, and enormous monetary support continuing persistently throughout. Other economies study those lessons carefully while simultaneously repeating surprisingly similar financial patterns under different political circumstances and narratives today. Technology alone cannot overcome incentives steering capital toward preservation instead of bold experimentation requiring tolerance for meaningful failure and uncertainty everywhere. Real innovation demands accepting losses alongside breakthroughs, something increasingly uncomfortable within heavily stabilized financial environments seeking constant reassurance everywhere. Ironically, protecting economies from every downturn may gradually weaken their ability recovering naturally when genuine transformations become absolutely necessary later. Muscles strengthen through controlled stress, not endless protection from every challenge encountered throughout life under comfortable conditions alone forever. Financial systems may follow surprisingly similar principles despite appearing infinitely more complicated than biological processes governing physical adaptation and resilience. Constant intervention reduces immediate pain while potentially increasing long-term dependence upon increasingly powerful policy responses after future disruptions emerge again. The permanent loop continues because escaping requires accepting short-term discomfort many societies understandably struggle embracing during uncertain economic moments today. Breaking cycles demands reallocating capital, encouraging competition, restructuring debts, and allowing certain failures despite uncomfortable immediate consequences for everyone involved. Those choices require extraordinary political courage because benefits arrive slowly while costs appear immediately across headlines and public opinion alike. Until incentives change, financial zombification may continue expanding quietly beneath impressive market rallies and reassuring economic announcements every single year. That doesn't guarantee catastrophe, but it challenges assumptions about what healthy economic growth truly looks like beneath impressive statistics today. Perhaps the greatest danger isn't collapse itself, but mistaking permanent stabilization for genuine long-term prosperity and resilient economic renewal instead. When survival replaces progress, societies gradually forget what vibrant economic dynamism actually feels like across generations growing within stagnation quietly. So ask yourself, if every crisis gets rescued forever, when does tomorrow finally become different from yesterday again?